In today's video, I'm going to help you understand if real estate makes sense as part of your financial plan. Hey everyone, I'm James Knoll, founder of Root Financial, and I'm here to teach you what you need to know to create a secure retirement. Now, chances are good you read the title of this video and you already let out an audible yes or no regarding real estate. Real estate is one of those things that has such strongly held opinions, and it's one of those things that can be either a really good thing or a really bad thing. So in today's video, I'm going to go over a simple example of how real estate can fit into your financial plan so that you can see if it makes sense for you. Now, when it comes to real estate, the big question is what's the return going to be and how is that going to fit in your plan? Now, before we go any further, I would love to hear from you. Do you like real estate or have you had a bad experience with it? Let me know in the comments below as we continue to go through this video. What we need though to start is a point of comparison. So is 5% a good rate of return? Is 10%? Is 20%? We need something to compare it to so we can understand how real estate fits into everything else. Well, a simple starting point is to compare real estate and the returns you can get there to the S&P 500. Not a perfect comparison, but what it's doing is it's giving us something to compare to. And what I mean by that is historically, the S&P 500 has returned about 10% or so per year. So if you own the S&P 500, that's going to give you, if we use history as our guide, an assumed 10% rate of return going forward. The question is, what will real estate give you? Well, there's multiple different components of real estate. There's the appreciation, there's income, there's depreciation, there's other benefits. So let's flesh that out so we can start to understand how you can begin to calculate that. Well, the first piece of that is appreciation. If you own an asset, you want that asset to grow in value. Now, if we look at real estate the past several years, the asset appreciation has been incredible. It's been double digits for many years when you average it out, but I don't know if that's sustainable. Could be, might not be, but what we have to start with is what's the long-term average appreciation on residential real estate if we're looking at that. Long-term, it depends upon the market that you're looking at, but it's been around 4% and maybe even 5% in some areas. So let's use that as a starting point. If you're following along at home and want to understand the appreciation on your piece of property, maybe you're looking at your market, what area of the country you're in, feel free to choose what you think makes most sense, but I'm going to start with 5%. Meaning, if you buy a piece of property, one of the components of the return you can expect to get is the appreciation on that property. To compare it to my S&P 500 example, if you buy a stock, you expect that stock, or you hope that that stock's going to appreciate in value. So that's the first component here. Now, the second component is the income you can expect to receive from that asset. So you might buy a stock and hope that that stock goes up in value, but that stock also might pay a dividend. So when you're measuring the performance of a stock, it's both the appreciation in the asset value and it's the dividend income that you're receiving. That makes up the return you can expect. With real estate, it's similar. We talked about the asset appreciation, and we're going to assume an appreciation rate of about 5% for now, but then let's assume that you're renting that real estate out. What you want to understand is something called the cap rate or the capitalization rate. And what that is it's the net operating income divided by the value of your real estate. So what's net operating income? Well, really it's the income that you're receiving from your piece of real estate minus any of the operating expenses. So let's take a look at an example. Let's assume that you have a rental property and it's worth $500,000. Let's assume that you charge rent of $2,500 per month, which comes out to $30,000 per year. Now you can't include that full $30,000 per year in your return because there's some expenses that are taken out against that. Let's assume you have $5,000 per year in property taxes if you live in an area with 1% property tax rates. Let's also assume there's $5,000 per year in upkeep. Well, what we have is $30,000 of income minus $5,000 for property taxes minus $5,000 for upkeep. $20,000 is our actual net income. So in this example, the cap rate, the capitalization rate, is the net operating income of $20,000 divided by the value of the property of $500,000. One thing to note is you're not including the mortgage in the net operating income calculation. Your mortgage is more of a cost of capital. It's the cost of acquiring financing from the bank. It's not the cost of owning the property and maintaining the property. So it's just the costs of things like upkeep, of things like property taxes, anything to keep the maintenance of the property that you have to pay, that's included in the calculation of your net operating income. So in this example, the cap rate's around 4%. $20,000 per year of net operating income divided by $500,000, which is the price of the property, that's 4%. Depending on what part of the country you're in, this number can be very, very different. I live in San Diego, and it's very common to see cap rates of 3% or less. When you look at the asset value, which is the denominator, and you look at the income that some of these properties are generating, you're not getting an incredibly high cap rate because people are buying the property sometimes for the appreciation or because of the desirability of some of these homes. I'll compare that to my brother who bought a home in Midland, Texas several years back. The cap rate on his property when he purchased it was 12%, meaning the income he could charge or the income he received from renting on his property was a much higher percentage of the value of the home. So you're going to have a wide spectrum of potential cap rates, but think of this, not a perfect comparison, but think of this as like the dividend that you're receiving on a stock. If I go buy a share of McDonald's or AT&T, I have the appreciation of the asset and I have the dividend that that stock is paying me. That's what the cap rate is the equivalent to. The income that you're receiving from it is another component of your return. So if we're assuming a 5% asset increase, or 5% appreciation, and 4% cap rate, according to this example, so far our total return's at 9%. Now there's other factors that we have to include as well, and one of the biggest when it comes to rental real estate is leverage. If we had no leverage and you bought your home in cash, really the appreciation and the cap rate would be the overwhelming majority of the return that you can expect. The reality is though, most people use leverage to purchase their property, and that can significantly skew your returns to the upside and potentially to the downside. Let's look at an example. Let's go back to that $500,000 piece of real estate that you have. Well, let's say you only put 20% down. That's $100,000. Well, if the property increases by 10%, so the value of the property goes up 10%, it's gone from $500,000 to $550,000. Look at this though. You only put $100,000 down. If we ignore everything else for a second, you put $100,000 in, the property increased by $50,000, your appreciation on your initial investment was 50%. That's what leverage does, is it amplifies the returns in either direction. So you can see how something that generates 5% return as an asset or 10% return as an asset, when you apply leverage to that, it really starts to increase what that return can look like, but it also works in reverse. Let's take a look at that same example. You buy a $500,000 home, the market drops by 20%. So now that $500,000 home is only worth $400,000. Once again, you only put $100,000 down, which means you borrowed $400,000 from the bank. If we exclude everything else for just a simple calculation real quick, your rate of return is negative 100% in this example. Your equity, which was $100,000 when you started, has dropped to zero. Because if you were to sell the home today, theoretically, you'd sell it for $400,000, you'd pay off a mortgage of $400,000, you'd be left with nothing even though you put $100,000 in. So that's how leverage really amplifies or does the reverse your returns in real estate. It's not just the appreciation and the income, that number is going to be manipulated by the leverage that you apply to it. Now the good thing with real estate is if you have cash and if you have reserves and if you're prepared for something like this, you can ride out some of those downturns. What happened a lot in 2008, unfortunately, is people overextended themselves with their mortgages and they didn't have cash reserves or savings or something that they could live on if something ever happened to their income. And when their income dried up and there was a job loss, they couldn't continue making those mortgage payments. When they couldn't continue making those mortgage payments, they were forced to sell. And because there was a temporary decline in the value of real estate, they had to sell at a loss. So the good news here with real estate is with leverage, assuming you're in a good position financially, you have cash reserves, you have some funding that you could access, you can see those downturns through. So hopefully that mitigates some of the risk and then still participate in the appreciation over time. Another factor in real estate investing is depreciation. So when you have depreciation, what you're doing is it's kind of like this phantom expense that you get to write off against your income. So if I have a home for $500,000, it rents out for $2,500 a month or $30,000 per year, I get to depreciate the value of that home. Now that depreciation schedule is done over a number of years, but it's not a true expense in the sense that you're not actually paying anything, but that depreciation is a write-off against the income. So in a way, that tax benefit can add to a component of the return that you're going to get, so that when you look at it as a whole, you're looking at the appreciation of the asset value, you're looking at the cap rate, you're looking at the impact of leverage, and you're looking at the tax benefits of depreciation. Once you factor all those things in, you can roughly come up with a rate of return expectation for that property. Let's go back to the beginning. I said, let's start with something to compare it to. If all you have is a rate of return, you have no idea. Is that good? Is that bad? It has to be based upon, or it has to be relative to something else. Well, if we look at the S&P 500 of 10%, to me, that's almost my personal starting point. If I look at all these components to rate of return on mortgage, and it doesn't exceed 10%, I'm asking myself, why on earth am I doing this? Why would I accept something less than 10%? Because with real estate, I have to deal with tenants, I have to deal with maintenance, I have to deal with things breaking or repairs being made. There's just stuff that's going to require my energy, my attention, my time. Why would I do that for a return that's less than, quite frankly, a passive return on a whole bunch of some of the best companies in the world? If I can get 10% for just putting my money somewhere, yes, I have to endure the ups and downs of the stock market. I understand that. But I'm not attending meetings, I'm not having to find tenants, I'm not having to deal with repairs, I'm not fielding phone calls in the middle of the night, I'm just letting my money ride. So that's my personal benchmark. Yours may be something different. But to me, I would like to look at that to say, if I can use real estate and get a significantly better return than that, then it probably makes sense. If I'm looking at a return that's equal to or less than that, it probably doesn't make a whole lot of sense, at least the way I look at it personally. Now that's just a financial approach. You also have to look at the non-financial aspects. Real estate's not just a spreadsheet decision. It's really what makes sense for you too. Maybe you love real estate because you like something tangible. Maybe the stock market just doesn't make sense to you. Now, I personally love it. I think that if you diversify and you invest the right way, it's wonderful, but maybe that's not you. Maybe you like having something tangible. You like being able to touch it and see it and know that it's there. Real estate could be an even better investment because of the personal preferences in that example. Maybe your desire is to keep property in the home for future generations. I've talked to many people who say, yes, we like real estate not just because of what it does for us, but we want to be able to pass these homes on to children in the future. Maybe there's memories at those homes, maybe it's just a legacy play that they have, but the other benefit of real estate is that it's something that can be a legacy play if you choose it to be. On the other hand, maybe you just don't want to be a landlord. Maybe you run the numbers and you say, yes, I see real estate, it's got a pretty good return when I look at the numbers, but I don't want to deal with it. I'd rather spend my time doing things I love, traveling, spending time with friends, spending time with families. I don't want to be a landlord and I don't want to get a property manager. Maybe real estate's not for you. Maybe you're not comfortable with some of the risk factors. I know some people think of a piece of real estate as more secure than maybe an investment in the S&P 500 or diversified mix of stocks. I personally disagree. If you look at one single piece of real estate, there's risks there. What happens if something happens to that piece of property, or there's an economic downturn in that area, or there's just horrible tenants or the place is destroyed? That's one piece of real estate. And yes, it's tangible, but compare that to an investment in the S&P 500 or a global stock market index. What you're getting is ownership of some of the best run, most profitable companies in the world. And if you go on a walk down the street right now, you're probably going to see some Fords or some Teslas driving by. You might walk past a Chipotle or McDonald's. You might see a Bank of America or Wells Fargo on the corner. You might pull out your iPhone to call your friend or check your Apple Watch to see what time it is. When you're doing any of those things, those are companies that you own when you're investing in the stock market. So as you're seeing the next Amazon truck go by, understand that when you own the stock market or you own a fund that owns the entirety of the stock market, it just seems like a value on a piece of paper or digits on a screen. But what you're actually getting is ownership in the best run and the most profitable companies in the world. And when you compare that to a single piece of property, you have to understand what's truly more risky. So at the end of the day, there's not a perfect answer that's right for everyone. There's financial factors that you need to consider. There's non-financial factors that you need to consider. But what you absolutely need to do is run the numbers for you. Understand what makes more sense financially as part of your plan, but also understand what makes more sense for your personality. So at the end of the day, whether you choose to invest in the stock market or real estate or anything else, you always need to know, how does this tie into your retirement plan? If you want to understand the 5 steps to understanding if you're on track to retire, be sure to check out this video above. Thanks for watching. This is James Knoll with Root Financial Partners. If you enjoyed this video, please be sure to share it with someone else who you think would benefit from this information. And also, please be sure to like and subscribe for more content just like this. Finally, if you'd like to see how we help clients create a secure retirement, be sure to check out our website at rootfinancialpartners.com.